Do not invest in S&P 500 if you want to build real wealth. I know that sounds crazy, but here's a fact that will shock you. If you put $10,000 into the S&P 500 back in 2018, you'd have $23,000 today. Sounds great, right? Wrong. After accounting for M2 money supply expansion, which is the real inflation nobody talks about, you've only made $7,000. That's barely 5% annual growth while risking 35% drawdowns in the best performing market of all time. I'm an ex-financial advisor who allocated over 10 million euros across Europe. Now I create content and I've built my own six-figure portfolio, yielding more than 25% annually in just 3 years. Today, I'll show you why the S&P 500 is barely a wealth preservation tool at best and reveal what actually multiplies money in this rigged system. Welcome to Psycho Investor, where we expose the uncomfortable truth about building wealth. They called me crazy when I said the S&P 500 is not worth it. They called me crazy when I went all in on Bitcoin and leveraged ETFs. They called me crazy when I built a portfolio yielding 25% annually. Well, who's crazy now? What you are seeing on screen right now is my actual portfolio. 6 figures, built in 3 years, 37 months to be precise, generating returns that make index fund investors cry. This isn't luck. This is understanding one brutal truth that nobody wants to admit. The S&P 500 is designed to keep you poor while making you feel rich. Today, I'm going to expose why M2 money supply makes your 10 or 11% returns completely worthless. I'll show you mathematical proof that S&P 500 investors are actually preserving wealth at its best. We'll talk about why you are risking 35% drawdowns for 3 to 5% real returns, which is absolute insanity. And then I'll reveal the aggressive strategies that turned my 30,000 into 6 figures. I'm not selling courses. This is just raw data and real positions from someone who escaped the financial advisor hamster wheel and now sees the game for what it really is. Let me show you the chart that will completely change how you see investing forever. This is M2 money supply. Since 2018, it's grown from 14 trillion to $22 trillion. That's 6.4% compound annual growth. This isn't inflation like they teach you in economics class. This is straight up money printing. Think about what this means. Every single dollar that existed in 2018 has been diluted by 60%. Your $10,000 from back then, just to maintain the same share of the total money supply, it would need to be 15,850 today. And that's your real baseline, not 10,000. Look at this comparison I'm showing you. CPI, which is what the government tells you inflation is, runs at 3% annually. But M2, which is what actually matters for your wealth, growth at 6.4% annually. That gap of 3.4%, that's hidden wealth destruction happening every single year. This is exactly why boomers bought houses for $30,000 and you can't afford one for $300,000. The houses didn't get 10 times more valuable. Your money became 10 times more worthless. Here's what this means for different assets. Cash loses 6.4% annually to M2 expansion. Bonds paying 4%, you are still losing 2.4% every year. The S&P 500 returning 11%, you are only gaining 4.6% in real terms. You are not investing to make money anymore. You are investing not to lose money to monetary expansion. And most of you are failing at even that. Since 2020, central banks have printed more money than in the previous 100 years combined. Where did all that money go? Into assets. Stocks, real estate, crypto. If you are not growing faster than this printing press, you are getting left behind while the wealthy get wealthy. This is the game the wealthy play. They understand them too. They leveraged it. While you are celebrating your 11% S&P returns, they are making 30% because they know what the real scorecard looks like. Now let's destroy the biggest lie in personal finance, which is that the S&P 500 builds wealth. Here's the brutal math since 2018. The S&P 500 returned 11.4% annually. M2 grew at 6.4% annually. Your real return, 5%. That's it. Your 10,000 became 23,000. Sounds good until you do the real math. The M2 adjusted baseline is 15,850. Your real gain is only 7,150. Your actual return above monetary expansion is 45% total, or about 7.7% annually. But look at the risk you took for that pathetic return. March 2020. You are down 34%. In 2022, you are down 25%. Multiple times you've seen 10 to 15% corrections. You are risking half of your portfolio for what amounts to pocket change in real terms. Let me put this in perspective with real numbers. You invest $100,000. After 5 years at S&P 500 returns, you have about $175,000 nominal. Adjusted for M2 expansion, that's about $130,000 in real wealth. Your real gain is $30,000 on $100,000. That's 30% over 5 years, which is 5.4% annually. This is what Wall Street doesn't want you to understand. They show you nominal returns because it looks impressive. But in real terms, you are getting table scraps while taking massive risk. So what actually beats monetary debasement? Let me show you what's been crushing M2 expansion. Since 2018, TQQQ, which is the triple leverage Nasdaq ETF, has returned 28.3% annually. That's 21.9% above M2. Bitcoin has returned 31.7% annually. That's 25.3% above M2. Select tech stocks that have returned 20 to 40% annually, which is 14 to 34% above M2. Yes, these are volatile. Yes, they have massive drawdowns. But if you are young and building wealth, volatility is your friend when the long-term trajectory is up. Look at TQQQ. Since 2018, $10,000 became $66,700. The real gain above M2 is $50,850. That's 400% real wealth creation versus the S&P's 50%. People always ask me about the volatility. Sure, TQQQ dropped 70% in March 2020. Bitcoin has dropped 80% multiple times. But here's what matters. They recovered and then multiplied. If you have 10+ year timeline, short-term volatility is irrelevant. What matters is the compound annual growth rate above monetary expansion. Higher volatility correlates with higher returns over long periods. The S&P 500 sits in the worst possible quadrant, moderate volatility with low real returns. You are taking risk without getting paid for it. Let me show you exactly what I'm doing with my actual portfolio. What you are seeing on screen right now is my real brokerage account. $124,000. Up 35,631, or 32% total return. Look at these positions. This isn't theory. This is real money at work. My biggest position is ProShares Bitcoin Strategy ETF, BITO. 2,550 shares, generating 60% returns. That's $23,547 in profit on a $48,000 investment, plus $31,437 in annual dividends at a 60.76% yield. Yes, you heard that right. 60% annual yield on a Bitcoin ETF. Next, I've got Main Street Capital, a business development company. 330 shares, up 48%. This pays $858 annually, almost a 4% dividend yield. Not massive, but it's steady cash flow from a position that also appreciating. Here's where it gets interesting. ProShares Ultra Pro QQQ, that's TQQQ, the triple leverage Nasdaq. 120 shares, up 25%, only pays $89 annually in dividends because growth is the play here, not income. This is pure price appreciation. JP Morgan Nasdaq Equity Premium Income ETF. JPQ. This is the income monster. 1,220 shares paying $3,619 annually. That's almost a 12% yield. This fund sells covered calls on the Nasdaq and passes the premium to shareholders. $3,600 in annual income from a $29,000 investment. Then I've got some smaller positions. MicroStrategy, which is basically a leveraged Bitcoin play disguised as a software company. 7 shares currently down 11%. No dividend because Michael Saylor uses every penny to buy more Bitcoin. I'm holding because it's a long-term Bitcoin proxy. The interesting one here is BitX, a 2 times leveraged Bitcoin ETF. 100 shares yielding 9% annually. That's $504 in annual distributions. Currently down 11.5%, but that income softens the blow while I wait for Bitcoin to run. My total portfolio shows 110,935 invested, now worth 124,000. The total annual dividend income is $36,513 after tax. That's a portfolio yield of 29.45% annually. Think about what this means. 36,000 in annual income from a 124,000 portfolio. The S&P 500 yields 1.3%. To generate 36,000 from SPY, you'd need $2.8 million invested. I'm doing it with 124,000. Here's how this income strategy works. Beta's massive 60% yield comes from the futures roll strategy and volatility in Bitcoin futures markets. JPQ 12% comes from selling covered calls on the Nasdaq every month. BitX generates income from its leveraged Bitcoin exposure and rebalancing. Look at the portfolio daily movements. Down 1,372 today. That's more than most people's monthly salary gone in a day, talking about Europe. But zoom out. Total profit of 35,631, the volatility is the price of admission for these returns. The key to this strategy is understanding each position's role. Beta and BitX give me leveraged Bitcoin exposure with income. JPQ is my cash flow machine. TQQQ is my growth rocket. Main is my stable dividend payer. MicroStrategy, my speculation on corporate Bitcoin adoption. And people always ask about sustainability. Can Beta really pay 60% annually? As long as Bitcoin futures remain in contango and volatility stays elevated, yes. Will JPQ keep paying 12% as long as the Nasdaq has volatility to harvest through options? Yes. This is real portfolio construction for the modern era. Not some boomer 60-40 stocks and bond allocation. This is leveraged ETFs, Bitcoin exposure, and option income strategies. 36,000 in annual income plus appreciation that's crushing the S&P 500. While index fund investors celebrate their 2% dividend yield, I'm collecting nearly 30%. While they worry about a 10% correction, I'm using volatility to generate income. This is how you build wealth when money printer goes brrrr. This portfolio generates more in annual dividends than most people save in 5 years. And it's from a 6-figure account, not millions. This is the difference between understanding modern markets and following outdated advice from the 1980s. Now, let me show you exactly how to implement this strategy. First, forget everything about restrictions. You can invest in US ETFs from Europe using options. Check this video on how to do this and reinvest automatically. Remember that everything I say is not a financial advice, but just my opinion based on uncomfortable truth and experience. Here's how to start if you are a cautious newcomer with around 10,000 euros. Put 4,000 in JPQ for the 12% yield. That's 480 euros annual income. Put 3,000 in QQQ, not TQQQ yet, to get comfortable with tech exposure. 2,000 in Bitcoin ETFs like Beta for diversification. Keep 1,000 in cash for opportunities. For the ambitious strategist with 50,000 euros or more, you can be more aggressive. 10,000 in TQQQ, but sell covered calls to generate income and reduce risk. 20,000 in income plays like JPQ and Main for cash flow. 15,000 in Bitcoin through Beta and BitX. 5,000 in individual tech stocks during dips or maybe cash. For tech-savvy explorer who really gets in with 100,000 plus to deploy, this is where you can build serious wealth. 20,000 in leveraged ETFs like TQQQ. 50,000 in high-yield income strategies. 20,000 in crypto exposure through multiple vehicles, and 10,000 cash reserve for market crashes. The execution rules are simple but critical. Never buy everything at once. Scale in over 2 to 3 months. If you're comfortable, extend everything to 6 months. When TQQQ drops 20%, that's a buying opportunity, not a panic movement. When Bitcoin crashes 30%, you double down, not sell. When everyone's euphoric and your portfolio is up 50%, you sell covered calls and take some profits. Tax optimization in Europe is crucial. In many European Union countries, you can use investment accounts that defer taxes. In Lithuania, where I am, it's 15% capital gains, but some investments are tax-free until withdrawal. Some countries have no capital gains tax after holding periods. Know your local rules and use them. Okay, let's recap the brutal truth I've shown you today. The S&P 500 is not building your wealth. After adjusting for M2 money expansion, you are making maybe 5% real returns while risking 35% drawdowns. That's not investing. That's barely keeping up with monetary debasement. The real wealth builders are doing something completely different. They are using leveraged ETFs like TQQQ for 28% annual returns. They are harvesting volatility with covered calls for monthly income. They are getting Bitcoin exposure through ETFs yielding 60% annually. They are treating volatility as an opportunity, not a threat. My portfolio proves this works. 124,000 generating 36,000 in annual income. That's a 29% yield while also appreciating 32%. Try getting that from your index fund. Here's your choice. You can keep putting money into S&P 500, celebrating your 11% returns while the money printer dilutes your wealth by 6%. You can stay comfortable with your 3% real returns and pretend you are building wealth. Or you can join the psycho investors who understand the game has changed, who realize that in a world of infinite money printing, you need infinite return strategies, who use leveraged volatility and income strategies to actually multiply wealth, not just preserve it. The traditional financial advisors will tell you this is too risky. The same advisors who put clients in bonds yielding less than inflation. The same ones who think a 60-40 portfolio still makes sense when bonds lose money for 3 straight years. They are playing by rules from 1980 while we are living in 2025. I am not saying put your life savings into TQQQ tomorrow. I am saying understand that the safe path is no longer safe. The risky path is the only one that leads to real wealth. Start small, learn the strategies, scale up as you gain confidence. The money printer isn't stopping. M2 will keep expanding. Assets will keep inflating. You can either ride this wave with leverage strategies that capture the expansion, or you can get buried by it with traditional investing that can't keep up. If this opened your eyes to what's really happening with your money, hit subscribe. If you think I'm crazy, good. They called every successful investor crazy until they were proven right. Remember, you are not competing against 0%. You are competing against the money printer, and the money printer always wins unless you are playing a different game entirely. Welcome to Psycho Investor, where we don't just beat the market, we beat the system.